sell treasuries, and then I'm going to sell dollars, but I don't want my currency to rise. What do I do instead? I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting. I think is going to happen this time around as we enter into a recession, which I'm almost 100% sure that we're going to see one this year, not sometime this year. We're already halfway there. Q1 is going to be profoundly negative. I would be surprised if it doesn't get even worse in Q2.
Gold prices are steady above the $3,300 per ounce level, reflecting elevated volatility amid persistent geopolitical and economic uncertainty. After briefly hitting a historic peak of $3,500, gold has pulled back slightly, though its underlying appeal as a safe haven asset remains intact. Michael Pento, president of Pento Portfolio Strategies, notes that this retracement is expected and should not be mistaken for weakness. He emphasizes that the policy environment, particularly President Trump's shift toward a standardized 10% tariff on all imports, has temporarily calmed market nerves, but has not addressed the deeper imbalances that threaten global stability. According to Pento, this backdrop still favors higher gold prices in the medium term. Pento also highlights the declining reliability of the US dollar and US Treasuries as traditional safe haven assets, especially as investor confidence in fiat-based instruments deteriorates. Recent data reveals a $125 billion outflow from U.S. money market funds in mid-April, the steepest weekly decline since the global financial crisis. Pento argues that this exodus signals rising concern over America's unsustainable fiscal trajectory, worsened by ballooning deficits and escalating interest payments on federal debt. He warns that the Federal Reserve may soon be forced to abandon its tightening stance and return to more accommodative monetary policy to stabilize the bond market. Such a move would further undermine trust in the dollar and intensify demand for tangible, inflation-resistant assets like gold. As a result, many analysts now forecast a considerable upside for gold in the coming quarters. With global investors increasingly seeking alternatives to fiat currencies, momentum in the precious metals market continues to build. Pento maintains that gold's upward trajectory is far from over, projecting that sustained outflows from U.S. financial markets could propel prices beyond $4,000 per ounce before year-end. While short-term fluctuations are likely to persist, he believes the broader trend remains decisively bullish. Consensus projections among market strategists now estimate an average gold price of $3,150 for 2025, with the potential to rise to $3,360 in 2026, an indication that the market is bracing for a prolonged period of demand-driven strength in gold. Now, we present the clips from Michael's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
China is one thing. You're right about that. I mean, we're talking about supplanting demand for our treasury bond market. What about Japan? Japan is the largest holder of our treasuries. And Japan, for a very, very long time, their long-term rates were 1/4%. Less than 1/4% on long duration Japanese JGBs going out 10 years. And now they're close to 1.5. So they have a viable alternative. But then you have to also talk about the trade war, which spiked really the blow up in the bond market. Just think about this. There's two functions here. If global trade grinds to a halt, let's just say there's no longer a huge trade surplus for Japan and China to recycle into our bond market and currency. If that goes away, the bid for our treasuries attenuates significantly. And then you also think about what happened with Russia and these arbitrary, capricious sanctions that we impose on countries. Say, listen, your savings is no longer yours. We're going to confiscate that for you. That started the belief that, hey, what if China is going to have a trillion, or I think it's about $750, $800 billion of their sovereign wealth parked into U.S. Treasury debt, and Japan owns $1 trillion. Whatever is a problem, the United States no longer thinks that that they are our friend. I think you can ask Canada about that. What did Canada do to us? Suddenly, there's a lot of antipathy between the U.S. and Canada. Well, what happens if, for some reason, some administration says, you know what, your sovereign wealth is now ours. We're going to freeze your assets. Does it make a lot of sense to hold a lot of your wealth, your nation's wealth, in another nation that has such fickle behavior? So that, and the fact that there's no longer that big trade surplus to recycle into treasuries, it's a big, big dent in the demand for U.S. treasuries. And you take that, you say, well, okay, if I'm going to sell treasuries and then I'm going to sell dollars, but I don't want my currency to rise, what do I do instead? I sell treasuries, sell the dollar-denominated treasuries, and buy gold. And that's why gold is supplanting the United States dollar as the world's reserve currency. That's a functionality of why we see these record-setting prices for gold, which I think are just starting. I think is going to happen this time around as we enter into a recession, which I'm almost 100% sure that we're going to see one this year, not sometime this year. We're already halfway there. Q1 is going to be profoundly negative. I would be surprised if it doesn't get even worse in Q2, unless we see an immediate cessation of the tariff conflagration, and we can get into that in a second. But it's hard for me to come up with a scenario where you're going to have a deal when one side of the argument doesn't even acknowledge the fact that we were having a discussion. So we're going to have a recession, and it might not be that deep, but it's hard for me to make an argument that you can see a flood of buyers for houses and a flood of buying into stocks, because this is, so as I can just finish my thought. So people start getting laid off. They stop funding their 401k when that happens. The market dives 30% or more, 40%. Then finally you get the attention of the individual investor, who is the only one really buying this market right now. The individual investors have never stopped. They have been so surely inculcated to buy every dip because the Fed and Treasury have your back, that they're just dying. This is like an opportunity for them just to, hey, buy every dip. And we can get into a reason why that's not going to work in a second. But so unemployment rate spikes, the market drops, the flow of funds into the S&P 500 dry up, and then you get the people who are employed always panic at the nadir of any bear market. They call up and panic and say, hey, they call the plan administrator and say, just get me out of my current S&P 500 fund. I want to go into cash. And then it goes from a 35% drop down to 50% drop. That's when you maybe start getting interest. That's when you see the buying. When you have forced liquidations of hedge funds and forced liquidations of funds in the shadow banking system, you could pick up some really good bargains. I think that's where we're headed, because I don't see any other way around it unless you see a significant reduction in interest rates ahead of this, which is not going to happen. Unless you see QE happening very soon, it's not going to happen. In fact, they're still into a very mild version of QT. And unless all tariffs that were imposed from Liberation Day go to zero, not 10, zero, I think you're going to have a very difficult time. Because don't forget, I'm sorry, I know I'm long-winded, but this market was in trouble. The economic situation was in trouble ahead of the tariffs because of the fact that the labor force was shrinking, and the fact that thankfully the government was stopping all their hiring. The government was doing all of the hiring. It was government and government contractors. That's why you say every month the non-farm payroll report was gangbusters, because 70% of them was a derivative of what government was doing. That stopped. So you have those two things happening. That's not a recession, but just means there's no growth in the economy. And when you add tariffs onto that, you get a recession.
Inflationary pressures continue to mount, posing a growing challenge for the Federal Reserve as it seeks to navigate its limited control over long-term interest rates. While the Fed can influence short-term borrowing costs through adjustments to the federal funds rate, long-term rates are driven largely by broader market forces and investor expectations. Given the ongoing inflationary environment and increasing fiscal instability, the Fed's efforts may prove insufficient in reducing long-term rates. In fact, Despite the central bank's attempts to lower short-term borrowing costs, long-term rates may stay elevated or even rise, complicating its ability to manage the broader economy effectively. As a result, traditional policy tools such as quantitative easing, QE, or rate cuts, which have been used in the past to stimulate economic activity, may struggle to have the same impact on borrowing costs across the economy. With the potential for long-term rates to remain high, the Fed may be pressured to take more aggressive fiscal measures, such as purchasing a broader range of debt securities to influence long-term rates. However, these actions could increase inflationary risks, destabilize the economy, and undermine confidence in the US dollar. The Fed's limited capacity to steer the economy with its current tools highlights the delicate balancing act it faces in addressing inflation while maintaining financial stability.
Inculcated through decades that, hey, I just wait for the Fed to cut interest rates to zero, and then borrowing costs come down, and then it'll reflate the asset prices. I think the major flaw here, Dunnigan, could be, which I didn't talk about before, which I was going to get to, is that when you have these iterations of crises, either recessions or a real estate bubble or a pandemic, and you attack them because you have a fiat currency, you have a tool that you have, it's called the printing press. You abuse two things. So you end up becoming an insolvent nation, and you no longer have a problem with deflation or disinflation, you have a problem with inflation. So now we have an insolvent nation and we have problems with inflation. So when you cut interest rates and go back to ZIRP and QE and spend more money on top of your insolvent condition, what happens is that long-term interest rates might rise, or at the very least not fall very much, as opposed to just following the Fed back towards zero. So you're going to get no relief in the mortgage market. You could actually have a huge problem in the mortgage market as mortgage borrowing costs spike instead of fall, as they usually do in recessions.
Can you please describe the mechanism of that? Because I think that's very valuable for our viewers to understand that the Fed can't control the long end of the curve as directly as they can the short end of the curve, and there are other market forces that drive that.
Right. So the Fed controls something called the Fed funds interest rate, which is the overnight interbank lending rate, which is what banks borrow from each other. And that's called the money market rate. And short-term interest rates, T-bills, compete with the money market rate. The Fed controls that very easily unless they're engaged in quantitative easing, which is direct purchase of long-term treasury bonds. And they have to be very aggressive on that front. An indiscriminate buyer of trillions of dollars of treasury debt, which in itself has a massive inflation implication. Then you cannot say that the Fed controls the whole yield curve dynamic. They control only the short end. And then you have to ask yourself, okay, Mr. Pento, what if the Fed assents to the notion of printing trillions of dollars to engage in QE to just bend down the long end of the yield curve? Well, my retort would be, are they going to buy mortgage-backed securities too? Are they also going to buy commercial paper? Are they going to buy corporate debt as well? Are they going to buy municipal bonds too? I mean, how much debt are they willing to really buy? Because you're going to have a huge problem in the economy. Is the Fed going to supplant the entire bond market, public and private sector? I mean, then you're talking about Zimbabwe. So I don't think they're going to do that. So I certainly wouldn't do it unless there was a massive issue in the economy. You're talking about a depression where both the money market, short-term rates and long-term rates were completely frozen. Repo market frozen. All types of debt was frozen, and they were the only buyer. And we're not there yet.
The Federal Reserve faces growing pressure as it grapples with the consequences of ballooning deficits and rising debt refinancing costs. Many market experts warn that the Fed may have no choice but to resort to aggressive money printing to stabilize the economy. However, this could lead to soaring inflation, as quantitative easing may not offer the same relief it did during previous crises. Unlike the 2008 financial crash or the COVID-19 downturn, the current challenges are more deeply ingrained. The U.S. faces a more difficult road to recovery with limited savings, a diminished manufacturing base, and a lack of fiscal discipline. In this environment, attention is shifting toward gold, seen as a safe haven for investors amid economic instability. The weakening dollar and growing inflationary concerns have made gold, particularly gold mining stocks, an increasingly attractive investment. Experts believe the precious metal is significantly undervalued, and demand for gold is set to rise as more investors move away from riskier assets. As inflation continues to challenge the economy and the dollar weakens further, gold's upward trajectory appears poised to strengthen, offering potential for substantial gains. That's it for today. Share your thoughts on Michael's analysis in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.